Hey everyone, welcome back to Corporate Decoder, the place where we expose the secrets buried in the fine print of corporate America. Today we're diving into a filing that tells the story of a company trying to make its big break into the public market, GSR IV Acquisition Corp, and let's just say their path to the public eye is packed with as many disclaimers as it is with zeros. This is a bit of a unique one, folks. GSR IV Acquisition Corp is what's called a SPAC or a special purpose acquisition company. Basically a company with no real business operations formed solely to raise money in an IPO and then use that money later to buy another company. Think of it as a dry check ready to be filled out for the right deal. This particular filing in S1A is an amendment to their initial registration statement. It's like a revised draft of their IPO plan, updating details and disclosures for potential investors. They're looking to raise about $200 million by selling 20 million units, each unit consisting of a Class A ordinary share later. This company is registered in the Cayman Islands, a common move for SPAC, shielding them from some regulations, but also raising questions for investors. Their principal executive offices are located in Austin, Texas. They're ready to go as soon as the SEC gives them the green light. They're flagging themselves as an emerging growth company and a smaller reporting company. This means they get to follow slightly less stringent reporting rules, which can sometimes mean less transparency for investors. Now, the prospectus itself is still a work in progress, as you can see by this date here. It's a preliminary document, meaning it's not the final offer yet. So what's the plan here? They want to find a business in the United States to merge with, focusing on high potential businesses. They haven't picked a target yet, and they're not even talking to anyone seriously about a deal. This means the actual business you'd be investing in is still a complete mystery. Let's look at the money side of things. Each unit goes for $10, but out of that $10, 55 cents goes to underwriting fees, which is pretty standard. That leaves them with $9.45 per unit to actually fund their eventual business combination. The total fundraising target here is $200 million, which will mostly be parked in a trust account. This money is meant to be safe in a trust account with a trustee holding it. It can only be used for the business combination or if the deal fails and they have to return the money to investors. They can take out a small amount for working capital, but the bulk of it is locked away. Now here's where it gets interesting. A bunch of their top brass are also involved with the underwriters Polaris Advisory Partners LLC. This is a classic conflict of interest scenario FINRA. A regulatory body is specifically calling out. It means the underwriters have a vested interest in this deal going through, not just because they're selling the shares, but because of their own affiliations. They'll need a qualified independent underwriter to ensure everything is done properly. That's where the Benchmark Company LLC comes in. And it doesn't stop there. The management team and directors themselves owned what are called founder shares and private placement units. These were bought at a super low price, like fractions of a penny. This gives them a huge incentive to get any deal done, even if it's not the best deal for the public shareholders, because their own investment is so cheap. They can make a profit even if the stock price drops significantly post-combination. Let's look at some of these dilution numbers. This table shows how much value gets chipped away for public investors. If you look at the dilution to public shareholders row, you see numbers like $3 or even over $9 per share in some scenarios. What this means is that for every $10 unit you buy, a significant chunk of that value could disappear due to the cheap founder shares and dilution from other sources. If you look at the pro forma net tangible book value after this offering and the sale of private units row, you see the actual accounting value per share after the offering and all the deal costs. Compare that to the $10 offering price and you see the dilution. In the maximum redemption scenario, assuming no exercise of the overallotment option, the book value is just $3.83 per share, meaning a 61.7% dilution right off the bat. If the overallotment is exercised, that book value drops even further to just 5 cents per share, meaning a potential 94.6% dilution. That's a massive chip away from your investment before the company even does anything. And remember, there's no real market for their shares yet. They're hoping to get listed on NASDAQ, but there's no guarantee. If a market doesn't develop or they get delisted, selling your shares could become very difficult or impossible at a decent price. On top of all this, the management team is juggling multiple other businesses. This means their time and attention might be divided, potentially impacting their ability to focus on finding and closing a good deal for GSR IV. They have a deadline to find a business to merge with, usually 18 to 21 months after the IPO. If they don't find a deal in time, tough luck investors usually get their money back and the rights expire worthless. This time pressure can force them to make hasty decisions or accept less favorable terms on a deal just to meet the deadline. Interestingly, they don't have a limit on how many shareholders can redeem their shares. This means if too many people ask for their money back to avoid a deal they don't like, the SPAC might not have enough cash to complete the acquisition, potentially killing the deal and leading to liquidation. Now let's quickly glance at their actual financial statements. As of June 30, 2025, they have very little in assets and a working capital deficit, which means they owe more than they have available. They owe about $64,000 to their sponsor. This is a small amount now, but as they burn through cash funding this IPO and their search for a business, these related party transactions could grow. Their general and administrative expenses for the 3 months ending June 30, 2025 were $78,000. This is pretty much the cost of running a shell company before it has a real business. They reported a net loss of over $81,000 for that same period. Again, this is expected for a company in this stage, but it shows where the money is going. Looking at the overall picture, the fundamental issue is the structure of these SPACs. The founder shares bought at pennies on the dollar create immediate dilution for public investors. Even if the company they eventually buy is successful, the disproportionate ownership of the founders and insiders means public shareholders might see much smaller gains than they'd hoped for. It's a model designed for the sponsors and early investors to win big, with very little initial capital. The big gamble here is whether they can find a decent company to buy and whether that company will be worth the price paid, especially after accounting for all the dilution and fees. If they fail to find a target within their time frame, investors get their $10 back minus some fees, and the founders get nothing for their cheap shares. It's a high-risk, high-reward situation heavily weighted towards the sponsors. From a Warren Buffett perspective, you're investing in a company with no operations, no revenue, and a management team with potential conflicts of interest, all with the hope that they find a diamond in the rough. The dilution numbers are a major red flag suggesting early investors are paying a premium for the dream of a future business combination. The risks are clearly laid out, including the possibility of becoming an investment company, which would be a regulatory nightmare. So what's my take? GSR IV Acquisition Corp is a classic SP play. The management team has experience in this space, having been involved with other SPACs, which is a positive, but the inherent conflicts of interest and the significant dilution are major concerns. For public investors, this is a speculative bet on the management team's ability to execute a successful business combination, and for that business combination, and for that business combination, and for that business combination to then dramatically increase in value to overcome the initial dilution. It's a high stakes game of financial, and for that business combination to then dramatically increase in value to Alright, that's our breakdown of GSR IV Acquisition Corp's IPO filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.